As the Federal Reserve has hiked rates from 0% to over 4.75%, the average interest rate on bank deposits has remained low, around the FDIC's national average for savings accounts of 0.37%. This has led many to ask the simple question: why aren't banks raising the interest rate on deposits? One reason is that they simply don't have to. The banking industry is kind of like the Hotel California. "Relax," said the bank man. "We are programmed to receive. You can check out anytime you like, but you can never leave." In today's economy, to have a money balance of any size is to have a bank account, period. There is literally no way out of it or around it. But what about cash? Sure, you can withdraw cash, but you're still a creditor to the Federal Reserve, the bank of all banks. The answer isn't complete, though. The banks could still compete with one another to raise deposits. For example, if Bank ABC wanted to attract deposits, they could offer 1%, while Bank XYZ across the street only offers 0.5%. So why don't they do it? For a more complete answer, we must revisit the concept of stateful. Banks, like humans, are stateful. What does it mean to be stateful? We did a whole podcast on it. But stateful is when a saved memory or experience alters future decisions or outlooks. People are stateful because they have memories and past experiences which necessarily impact their future actions. Banks borrow short by accepting demand deposits and then lend long by long-dated treasuries or mortgage-backed securities. The bank must buy an asset for every deposit they accept or liability. Remember from our article on the collapse of SVB that banks, quote, need to get a yield on their assets that is greater than the cost of their deposits, including the overhead of administering the program, employing people, etc. No one, not even a bank, is above or outside the market. If you have deposit inflows in 2020, then you buy what's available at that time. You are a price taker. Banks are stateful because they cannot wake up one morning and forget about all the assets they purchased during a predominantly low to zero to negative interest rate environment, despite a small hiccup from 2015 to 2018. And they accelerated purchases of assets in 2020 during a period when interest rates made historical lows, including the 10-year note hitting 0.57%. Consider what we said recently about SVB's collapse. Even if the banks weren't trying to recapitalize themselves by offering low interest rates and earning higher rates, they would not be able to offer anywhere near the current market rate. This is because banks are stateful. They simply can't sell everything they bought over the last 10 years, let alone 10 months. They have to wait to roll their maturities to capture the momentarily higher rates. This is the primary reason why banks cannot raise rates on deposits. The average yield on their asset portfolio is much lower than the 4.75% that Powell just hiked to, which banks could earn on their new deposits. How much lower is difficult to say. Bank balance sheets are notoriously opaque. However, if we were to get out a pen and turn our napkin over, we could use the Federal Reserve's balance sheet as a proxy for the banking system at large. According to certain analysis, the average duration of the Fed's portfolio was 8 years in 2018. Using crude math, we guess the average yield of the Fed's portfolio in 2018 to be around 2.61%. If the Fed simply holds to maturity, replacing assets at market as they roll off, and keeps the same average duration, then their average yield would almost certainly decrease from 2018 to 2022, given that interest rates declined during this period across the entire curve. With a little back-of-the-napkin math, and admittedly some large assumptions, you can see why banks would be reluctant to raise rates on deposits when A, they don't have to, and B, they would be directly eating into what little margin they have. The third and final reason why banks aren't likely to raise rates on deposits is that they can get the required funding elsewhere, namely at the Federal Reserve. We wrote last week about how the Federal Reserve created a new program to provide new funding lines in response to bank troubles. We only have one point to make here. It's this. If the Federal Reserve is offering troubled Republic Bank and other banks $1 for 80 cents worth of collateral, albeit at higher rates, they'd be a fool not to take it. And this, folks, is called an incentive. When it comes to describing the incentives native to today's monetary and banking systems, there's a preferred adjective we like to use: perverse. And this is about as perverse an incentive as they come. One thing is for sure, As long as the Fed is incentivizing banks with this funding, banks will be in no hurry to raise the rates on deposits. Whatever word you want to use for the current system, free is not that word. Everything we've described above is in direct contravention to the principle of a free market in money and credit. There is no way to avoid being a creditor to the Federal Reserve and the banking system. There's no way to affect any real change in interest rates. Instead, short-term interest rates are set by a non-elected committee of 12 people acting on behalf of billions. And lastly, there's no penalty for engaging in harmful, wealth-destroying activity. So it would seem at least, but the bill will come due. Another term for interest rate manipulation, especially to the downside, is financial repression. We need the freedom to choose what money we want to transact in. We need a financial system that is responsive to the changes in desires and time preferences of savers and wage earners, as well as the marginal productivity of entrepreneurs and companies. We need a system where individuals are responsible and accountable for the consequences of their decisions, for good or ill. In other words, we need a system where incentives are properly aligned. We need monetary metals. Speak to one of our relationship managers to see how we can help you diversify your portfolio away from bank risk while earning a yield on gold and silver paid in gold and silver. See you next time, and make sure to subscribe.